Welcome back, everyone, to a brand new episode of the Crypto and Muay Thai podcast. I'm your host, Chris Brookins. I'm super excited today to welcome our very special guest, Shiliang Tang. He is the CIO of Ledger Prime and just an all-around nice guy. Ledger Prime is an investment fund that's based in the digital asset space that has more of a quantitative flow to it. Without further ado, let me introduce our special guest, Shiliang. How are you doing today?
Good. Thanks, Chris. Thanks for having me.
Awesome. It's a pleasure to have you. I'm super excited to be able to talk to you again. It's been too long since everything that has gone on with quarantine.
Yeah.
I think it was November of 2019 the last time I got a chance to see you in person. So it's a good time. It's a good experience to be able to see your face again and have a talk to you. So for those listening who might not know who you are, just feel free to give like a 2-minute synopsis just of your background, and then also how you kind of found your way into this wild world of digital assets.
Yeah, of course. I maybe came into the financial markets a slightly convoluted path. Not really didn't really study finance or markets at all in college. Did chemical engineering. Was more interested in the sciences. But after a couple of years of late nights in the lab, definitely wasn't a career path for me. And at the time, this is pre-2008, Wall Street was on fire, the kind of hot space, and they were obviously hiring quants and individuals who didn't necessarily need to understand the markets, more just could program and understand the math. And so interned at a few places, ultimately ended up at the Merrill prop trading desk on their high frequency trading and derivatives trading desk at the time. And that's primarily where I've been most of my career, right? It's on the algo trading derivative side of things. And so my team and I currently come from the traditional asset world. A few of us worked together back in the day and basically applying a lot of the same strategies to Ledger Prime, which we started in 2017. And Ledger Prime is basically a quantitative trading firm. We've made a conscientious effort to invest and focus on the derivative space and digital assets, with knowledge that looking at traditional assets, derivatives markets generally are always 10, 20, 50x the size of spot markets, right? And so I think if you think digital assets is going to be an asset class to stay for the long term, then absolutely we'll see the same kind of market size for an opportunity for derivatives in this space. And then personally in crypto, it was also always something that I kind of had that in the back of my mind, kind of followed on the side when I was in traditional assets. I think a lot of it stemmed from just the general financial crisis, and then mostly back in like 2010, 2013, the European financial crisis, specifically, right? Greece and the Cyprus financial crisis. I think exposure of Cypriot banks to over-leveraged local property companies, the Greek government debt crisis, all of that ultimately led to at the time, I think what was shocking at the time was depositors at bailed out Cyprus banks lost something like 50% of their savings, right, exceeding 100,000 euros. And so that was like eye-opening for me. And so crypto and Bitcoin specifically at the time being this asset that was outside of this traditional financial markets, but also an asset that could go up hundreds of percent at a time. It caught a lot of attention on Wall Street trading desks, right? And for me, it was also always something that I dabbled and traded in personally. And I think in 2017, when it became a bit more mainstream and markets were more liquid, and I thought I could actually allocate a decent amount of capital to it, I think it made sense for me to fully dive into the space, head on.
Got you. That makes sense, and we kind of hear a few similar stories, specifically whenever we're talking to some of like our more quantitative focused investment guests. So like I said on a previous podcast, things typically, whenever you start like in this particular market, there's a whole bunch of like hair, as we used to say in banking, that you don't necessarily know about until you're in the space. So obviously you guys or some of your team members, you from a traditional asset class, you look at this space and you're trading it even on the side, maybe even develop some computer programs to be able to trade it on the side, but now dedicating an entire investment fund to it and then looking to build out a more sophisticated system suited for institutions. what were some of the learning curves that you guys went through in that initial phase and or still going through as like the market infrastructure, but also the market participants gradually evolve in this space?
Yeah, I mean, that's a great question. I think one is just the infrastructure itself, right? It was always something we took for granted. You know, I'd show up at a desk when I first graduated, and all the data was there. All the data was clean. There were a ton of vendors you could purchase the data from. All the connectivity to the exchanges were well greased, well tested. You don't have to worry about connections going down all the time. And you know, you just had functional, well-oiled, you know, markets and machines and data, and you could just plug in your models and do these back tests and get the results, right? You know, there's a saying in quantitative finance and data analysis where you're spending, you know, 80-90% of the time just cleaning and working with data. But that applies to actually, you know, well greased and clean data. And now you're in crypto, where at the time, at least back in 2017, you know, it was still kind of a very, very emerging asset class and all these platforms and exchanges, and there was really no clean data or providers. And so we were having to do all this ourselves, and we're probably spending 99% of the time just trying to get the data and actually clean it so we can actually, you know, stick it in the models that we had from before. And we're still kind of going through the growing pains of that, right? I think it's just, you know, everything's so fractionalized. Especially for quantitative, you know, finance, you know, you need tons of data to train your models. And not only is the data, you know, not necessarily clean, but you're going through all these regime shifts in crypto itself, right? The 2017 market, 2018, 2019, completely different. You know, this is an emerging asset class. It's almost like trading emerging assets. I don't know, the currencies, let's say. And you know, the markets and the general macro environment has completely, you know, shifted year after year the past few years, and I think that's ultimately affected the various regimes that we've seen. And so, you know, just being very cognizant of that and not overfitting your data. You know, so we've taken and you know, with that on our mind, we've thrown out a lot of the more complicated models and focused more on you know, some of the easier strategies that honestly still work, right? Anything from like exchange arb or basis trading, very, very simple things that, you know, obviously don't work in traditional assets, still work, you know, pretty well in crypto. And so that in itself, you know, has been great. And I think, you know, until the ultra large institutions, you know, get into the space, you know, those strategies will still, you know, work quite well. And that's more of just the general infrastructure build as opposed to trying to figure out the data and various, you know, regimes that we inevitably go through in this market.
Gotcha. So talking about regimes, do you guys account for that in any way or try to model it? So you said that you simplified your models given this sort of like rapidly changing regimes, which typically change quite violently, not necessarily with a whimper, so to speak. So is there any other ways that you guys look to manage that particular risk? Do you look at the fundamentals? Do you look at just the general macro environment? Or do you just simply say like, all right, we're just going to keep you know, it just straight steak and potatoes with the very simple models and make sure that we're monitoring them based upon whenever we think or whenever we see that the regime might be adjusting?
Yeah. Yeah. I mean, I think, you know, there's this growing space, even traditional assets, the past couple of years of quote unquote quantamentals, right? And so we're trying to apply a little bit of that, just at least following the various events that do affect digital asset prices, right? You know, everything from like mainnet launches to conferences to events that a protocol or project announces that obviously affects you know, the prices, right? Or even like Fed announcements or Fed decisions for like the larger coins like Bitcoin. Obviously, at a high frequency time frame, that does affect prices. And so just taking all of that into account and modeling that and putting into the data as opposed to just looking at specifically numbers and prices previously, I think has helped, you know, definitely a ton, right? And all these things, you know, definitely continuously shift, right? I think like back in March and slightly after that, all the macro and Fed announcements had huge impacts. And now it's a little bit less so. And obviously back in like 2018, none of that mattered. And so, being aware of that and just tracking that, while manual and perhaps less systematic, it definitely has helped us a bit.
Got you. That makes sense. So you mentioned before, I guess like your general hypothesis is that if you're looking at this particular space, or you're looking at traditional asset classes, and seeing the size of the derivatives markets and or the opportunity within derivatives markets, and you think that this asset class will be here for the long term, that you would subsequently see a similar growth there. What are some of the areas like that you're currently seeing, or some of the areas of opportunity that you're currently seeing within the derivative space, knowing that infrastructure is even a bit more frontier, at least what is kind of regulated within the US from my particular perspective? And where do you potentially see some of those opportunities in the future as the infrastructure and or participants gradually grow in size and sophistication?
Yeah, I mean, that's a very broad topic, but tons of things we can touch on, right? One is just the unregulated versus regulated space, right? Unregulated markets in derivatives make up more than 90% of the market share, right? And so right now, that market, that capital, obviously controls a lot of the pricing power, right? And for good reason. To get set up on an unregulated exchange, it's so much easier from a KYC, ML, onboarding, versus a regulated entity like let's say the CME, right? You need an FCM relationship that effectively eliminates most of the retail, or you can sign up for Charles Schwab or a Ameritrade account that eliminates a lot of offshore retail accounts. And so you eliminated like two of the largest segments in crypto, which is just retail and offshore. And so if you look at pricing for these two exchanges, huge dislocations often in terms of, let's say, the basis and contango of futures curves, or even the options prices of, let's say, tail options, right? The cost of capital is orders of magnitude higher on a CME or regulated exchange versus, let's say, Deribit or BitMEX. And so you get these weird different price dislocations that you can take advantage of, if you have a cheap, cost of capital, or your cost of capital is better, right? Definitely it's a huge opportunity. We have seen a bit of a pickup, I would say, the past couple of months in regulated exchanges and the volume, such as the CME. Obviously, Paul Tudor-Jones announcing that he's getting into the space. His exposure is obviously in futures and not directly in the spot markets. And then the option space, we've also had a new multi-billion-dollar asset manager coming to the space, and that's also just on the CME. And that's had huge impact as well on the markets there. And so that's created various differences in the prices and vol surfaces between the regulated and unregulated space. And then the final thing that I want to touch about is structured products, right? These products have existed in traditional assets for many years and even decades, right? A lot of them are, let's say, they exist in the corporate space in traditional assets. So you have firms that want to hedge, you have firms that want yield, especially in Asia, right? Yield generating products are huge and immensely popular. And I think, crypto is a natural extension of that. And so we've seen the past few months, and obviously more than a year, of just these structured yield generating products packaged essentially on the back end as just vol selling or option selling. And so that itself has trickled, as a market maker, right? You're making markets for these structured products. On the back end, you have to hedge. And so, market makers have to leak that flow onto the exchanges. And so that's put, a damper on a lot of the implied vol surfaces, in Bitcoin or Ethereum. And it's had a huge impact just on the space. So I think, a ton of opportunity in terms of new entrants, institutional investors into the space that will affect pricing and financial markets, but also just more complex, exotic, structured products that, definitely will have a huge, impact and opportunity as well.
Got you. So how do you guys look to take advantage, of that? What are obviously, anytime we're talking to quants, we know that there's going to be a certain layer of intellectual property that cannot be disclosed. But how, like in a general framework, do you guys look to take advantage of currently what's going on within the derivatives markets, and or what you kind of like see the path potentially going in the future?
Yeah, a lot of it is not like traditional markets where we just see these dislocations and we can just kind of trade it like without a thought, right? So much of it is one, getting your investor base aligned, so your cost of capital matches the exchanges and exposures that you want exposure to. And the other is basically aligning your models to kind of know the different flows and counterparties and when they're going to trade, when they're going to erode their exposure, when these structured products are going to get put on. So taking that into account, which is a lot more, I would say, subjective than kind of number crunching, et cetera. You can have your models. Obviously, they'll always tell you something is cheap or rich, or you should do this, or you should do that. But you have to have the you have to put that in the broader context of whether, is 1% difference between the CME and Deribit enough in terms of a return difference to justify the cost capital differences, right? And so all these things you're taking into account. And so we made a huge effort in making sure that our investors understand the markets that we want to get in, the returns that they're expecting from us. And that we allocate the capital based on different platforms, because there is no prime brokerage in the space, right? You can be long on one exchange, short on another. You having to post collateral on all these different exchanges. It becomes quite capital intensive. Your risks don't offset. And so we're at the end of the day, like so much of crypto is just managing your capital and balance sheet, something that you think a bit less of in traditional markets. Because you have prime broker relationship, you can offset your risk and everything else with the clearing houses and FCM and everything. None of that exists in crypto at the moment. So it's been surprising, and we thought it would be pretty simple in terms of just our model is running and humming, but at the end of the day, it's just a lot of just relationships and more of the traditional finance and banking that I didn't think I would really need to think about.
Got you. So you mentioned a couple, or you mentioned a keyword there, risk. You mentioned it a couple times. So how do you think about risk in this general market? Obviously, what you're sort of like talking about, alluding to there is counterparty risk. So obviously, you've got to take that into consideration, especially within this particular market. And you mentioned prior talking about like regimes, given how quickly things tend to switch in this particular market and how violent they tend to be. Are there any other ways that you guys look at risk, given your particular methodology and or some of the particular nuances of this market?
Yeah. I mean, just having gone through being in the space for a long time, right? The volatility in this market is just astonishing, and it continues to surprise. I mean, even having traded through 2014 and Mt. Gox and then 2017, and what happened in March surprised me and surprised I think a lot of people that have traded through the markets. We never expected that. We could have expected it, but we didn't expect what really. I mean, when you're living through it, it's just completely different, right? And so I think just understanding that leverage is a tool that can be used both for good or bad, and just making sure that you don't overexpose yourself to one particular counterparty or platform, that whatever you think the worst can happen in terms of various VAR metrics or standard deviation metrics, you can be sure it could be go a lot worse, right? And I think having the mentality of not maximizing upside, but really minimizing downside, that's been our philosophy, right? It's kind of a market neutral fund, making sure that we really limit capital losses and downside, and not really worrying about the upside as much, has made our investors comfortable, really made ourselves, our lives a lot easier, right? And so always just, cutting losses, making sure we're keeping risk tight, that, our models, whatever we're running, worrying more about just the drawdowns, and, making sure that whatever, illiquidity premium you're applying to these assets, you're doubling or tripling that, right? Because, in a market shock, crypto being this nascent asset class, liquidity just goes out the window. So all these things we've learned a bit from traditional markets in 2008, flash crash, all of these things. And so, that's helped us a lot in terms of trading crypto.
Gotcha. So do you guys have specific systems in place like for said flash crashes? Because you said something that, was, sort of resonates with me. And I've mentioned it before, that it was sort of articulated to me, is liquidity is like an accordion. It can just sit out there and you're like, okay, there's a lot of liquidity, but whenever
Mhm.
shit hits the fan, it
Yeah.
quickly shrinks up and just sort of goes away, which obviously we've seen several times this year, just, in 2020 alone, with March
Yep.
flash crash being one of the most pronounced ones. So do you have additional systems in place, or do you just always have your risk parameters, tight enough so that even if there's some massive slippage, you still know that your overall, VAR is the X percentage, which is still well beneath, what your max drawdown would be if you're talking to LPs?
Yeah. I would say it's definitely more of the latter. I think relying too much on models, especially in a chaotic and unpredictable in a market that lacks many years of data. I mean, even like in traditional assets in 2008, the financial markets have been around forever, and people have, had complex models and have tried to predict that. And at the end of the day, no one really saw and expected what happened in 2008. Right? And so to blindly follow models and think that you can predict, what a worst possible outcome is, I think is pretty naive. And so, we have that in the back of the mind. We have our models, but just understanding that when things start to kind of go towards the negative outcomes, just playing it a lot safer than even our models kind of dictate, helps a ton. And I think no one's going to fault you for not making capital, but people are going to be quickly on you if you start to lose, a lot, right? And so that's something that's constantly evolving. But yeah, just always targeted towards the downside. What various vol shocks look like, and then I think the rest will take care of itself.
That's a very like institutional mindset, how you're sort of talking, because like within this space, it's very much driven by FOMO with this most recent sort of uptick in prices, and everyone expecting the subsequent bull market to be driven by retail, which kind of flies in the face of the traditional narrative that we've been hearing since 2018, that is the institutions that are going to come in and take us to new heights, a la 2017. So that's a very traditional, or I should say a very institutional mindset, how you're talking about. So whenever you're thinking about capping downside, making sure that you're trimming off the rough edges for your limited partners, do you just assume that the models over time will just make enough money to sort of justify the additional risk of being in this space? Or is it some kind of combination of, I trust the technology that we built, and we believe that this market is overly skewed to the upside? So like the expected return that we sort of extrapolated out maybe over the next 5 to 7 years, we expected to cover well in excess of like the additional risks that we're taking on by just being participants in this market.
Yeah, I mean, absolutely. I think the market is extremely inefficient in crypto, right? I think, you have to have the mentality that you can't catch every single move. But, this is an extremely volatile asset class where, okay, just because you don't catch like 1,000% move, like, even if you catch like 50% of that is more than enough for the average institutional investor, right? And so knowing that in the back of our mind, and knowing that there's so much alpha that can be captured, even if we catch a small sliver of it, most of our investors will be more than happy, right? And so we don't need to like FOMO. We don't have to catch every single move. There's so much upside, not only in just price, but just in terms of the opportunities, in terms of new asset classes, inefficiencies, different regulatory regimes that create different prices. Just catching a small sliver of that will have astronomical returns for many participants, right? And so the name of the game is to stay alive, so that over time you can capture this. It's not to try and hit it out of the park and blow it out of the park in 1 year. And I think that's helped us immensely in terms of like 2018, where obviously we're going to catch all of the upside in 2017, but we we're still going to generate a positive return in 2018, and despite the market being down 60-70%. And so yeah, it's for the long game. We know how the game's played. we're not in it just for the next year or two, right? So.
I really like that mindset and that philosophy, which is very difficult to stick to, in all honesty, without a set of rules, discipline, but also some quantitative models running like automatically in the background to remove the human from behind it, because it's extremely emotional whenever you see prices fly against you 20%,
Yeah.
or whenever you see prices go up 20, 30%, and you're like, shit, I want in on that. Why wasn't I in on that? So it's very difficult to control those emotions. So I think that like general mindset and how you're talking is very, very valuable, not just to investment funds like yourself that obviously come from a traditional background, but also for some of the more like retail focused investors that might be listening here. Like the key is not to blow up. Again, this isn't investment advice, but over the long time, it's like, you do not want to blow up. So you mentioned one thing in there talking about there's always opportunities abound. And I totally agree. There's always something new. And I look at this space almost like a perpetual .com bubble. A lot of people think that, it's going to wither away and Bitcoin and a handful of other maximalists will rule the roost. I don't personally see that happening. Whether or not Bitcoin will be the top asset for forever and ever, I don't necessarily know, but I do know or strongly suspect that there will be always a soup du jour of digital assets. Like there's always a soup du jour of new startups looking to come up and displace the incumbents and or looking to attack new market verticals that are being created through technology. So I don't think that's ever going to go anywhere. And I think there's always going to be a retail component, because the liquidity, once you start straying outside of the top 10, top 20, is not going to be suitable enough for the large institutional investors, whether or not they're just buying and holding or they're allocating to funds like myself or yours that are looking to move around a substantial amount of capital. So there's always going to be opportunities over there. With that being said, where do you guys primarily play and look for areas of opportunity? And I say that because you mentioned like new things are always cropping up. I'd be remiss if we didn't talk about sort of like the big thing of 2020 so far, which is DeFi. Every Tom, Dick, and Harry out there is making a new DeFi protocol, and it seems to be going up, 100%, 200%, 300% on a daily basis.
Yeah, I mean, absolutely. You always have to look at the new markets, right? I mean, you can have a broader trend of like, we think derivatives are going to grow in asset class, but that takes time. It takes many years. But in the short time frame, you have different pockets, right? In 2017, it was ICOs and smaller coins. While we don't participate in a liquid private investments, we can still participate in the inefficiencies some of these coins have when they're trading on exchanges or publicly, right? And so there were a ton of dislocations in some of these smaller coins in 2017. And, we're seeing the same thing in 2020, right, with these DeFi products and tokens. And so we're still participating in that, but maybe a different flavor, right? So instead of, centralized exchanges, there's decentralized exchanges. And while there's huge smart contract risk and risk in general with decentralized exchanges, I think, carving out a small portion of your capital, knowing what the risks are, having a conversation with the LPs, making sure they understand the risks, and then taking that small pool of capital and taking advantage of the potential returns in these markets can generate significant alpha, right? And so we're doing a little bit of yield farming, we're doing a little bit of market making on some of these exchanges. It's kind of the same game, just different flavor, right? I mean, you're still market making, you're still providing liquidity. It's like staking, and it really it's no different. And so yeah, we're definitely participating in this new opportunity.
Got you. That makes sense. I mean, for your particular strategy and how you guys view the market, just like you said, it's just an additional sort of avenue to be able to participate in that. Assuming there's different risks and everything tied to that, given yield farming, in theory is decentralized versus, market making on general exchanges as well.
Yep.
So do you guys do staking as well?
We do a little bit. I think more of just if we have a token that we want to market make in, where we have a general longer term momentum signal for, then it makes sense to at least collect the yield that is being thrown off, let's say on a weekly basis, some of these tokens like synthetics, right? It's just free money that can dampen the volatility to a certain extent of these tokens, if you're holding it from a longer period, right? And so I would say the longer term signals that are like trend following and momentum, to the extent that we can easily get in and out of these staking mechanisms and collecting the rewards, then it makes sense for us, to at least collect, quote unquote, the dividends that exists.
Got you. Yeah, we do the same exact thing whenever we see, our particular longer term, which is a little bit loaded in this particular space. Whenever we feel comfortable with the current trend and or we like where the asset's sitting, we do the same exact thing. Because just like you said, it's free money in theory. What's your like view of long term in this space? I know that line continues to get pushed and pulled, but how do you guys generally view, some of the short term mechanisms that you guys, or the short term opportunities you look to take advantage of versus maybe you've got a thesis surrounded by momentum and or supported by some fundamental metrics that you look at and you're like, all right, I want to hold this for X months or something.
Yep. Yeah, I think short term can be extremely short, right? It can be seconds, sub-seconds, just arbitrage. Longer term, I would say, it depends on the coin. I would say the more liquid a token is, the more comfortable we're holding it for longer periods, because we know we can get out of it, with a click of a finger, and we can get out of it in any environment, right? With more of the liquid coins, obviously it takes a bit more time, and so we'll never get a large position. And generally, we won't hold it, perhaps for that longer period. And so, in terms of specific timeframes, I would say that is more on the order of days to weeks. So that's our kind of definition of longer period, right? And so, obviously, that's still very, very short compared to like a fundamental investor or a VC investor. But again, that's just not what we're targeting, right? Some of our other positions, maybe in options, are a bit different. Options markets are pretty liquid. We play the implied versus realized ARB, maybe different ball surfaces. Obviously, those positions we can't just get in and out easily. A lot of times we have to hold it to expiration, which can be months. But those we feel a little bit more comfortable with, just in terms of being able to hedge it with other options. At the end of the day, it's still Bitcoin and Ethereum options for the vast majority, and so they're still fairly liquid. So.
Got you. That makes sense, and it's interesting too. I guess it aligns kind of with your strategy and general philosophy of how you take advantage of this market. It's a little bit shorter than whenever we look at quote unquote longer term investing, but also our strategies differ a little bit. So this might be a little bit of a loaded question, given you're a market neutral fund and you don't necessarily care which way the wind's blowing. How do you feel about the current market environment? So obviously we're sitting approximately like 25% up in Bitcoin and numerous, a lot more up in some of the other smaller coins, not like alt season, but Ethereum, Litecoin, and some of the other larger top tens. How do you feel about the general market environment, given it as quickly went from, malaise to exuberance again, where everyone thinks this is potentially the beginning of a multi-year bull market cycle?
Yep. Yeah. I mean, it feels perhaps eerily similar to the kind of the early days of 2017 or even 2016, right? And so there is, definitely some enthusiasm, bubbling. DeFi maybe replaces ICOs this time around. Things are looking pretty healthy in terms of the large caps like Bitcoin, Ethereum at least. And so for us, we are starting definitely to see a pickup in volatility, seeing pockets during this volatility of similar things that have happened in 2017, right? Just complete dislocations in price. This time around, though, there's a lot more tools at our disposal, right? There's actually a very robust and active derivatives market. Everything from futures, perpetuals, options, which a lot of times didn't exist as much back then. And so you have new opportunities like basis trading and vol arb that we're deploying versus things that we couldn't deploy as actively in 2017. So that's great, right? And volatility ebbs and flows. Wouldn't be shocked at all if volatility was even greater than in 2017. This time around during this time, this bull market, especially if people are throwing out numbers like 50,000 or 100,000 Bitcoin price targets. Absolutely, in a supply constraint market like Bitcoin and any other commodities, volatility tends to blow off. And so knowing that that can exist, but also being cognizant of the fact that there's so many more instruments at our disposal this time around, it's extremely exciting for us.
Got you. That makes sense. I think from my particular perspective, I tend to agree with you that I see similarities in kind of how the market is structuring and shaping up, not just from a macro perspective, which everyone's sort of pounding on the table in terms of just the US dollar. It's like there's one way that policymakers are looking to push the dollar, and given Bitcoin is denominated in it, then it's going to increase in prices. But also looking at technicals too, the technicals look very much there, and we're getting to that point where for better or worse, the FOMO is starting to set in for retail, not just retail, but also, hearing from some fiduciaries, small level fiduciaries. And I can just imagine that will eventually matriculate over to some of the institutions as well. I've long held that one of the next big sort of almost like dam breaking dollars that could flow into this space is whenever larger institutions that manage retirement funds realize, or they have their day of reckoning for their unfunded liabilities, and they're like, oh crap, like we've got to fill this gap. I've got 10, 20, 30% of my workforce retiring next year. It's like, all right, shit, how do we fill this? And you just look again strictly at an expected return profile over the past 5 years, 7 years, and that's going to point you squarely at digital assets. So there's still going to be a little bit of hair in allocating to that, but there's more and more funds that are sort of removing that so that it fits within their mandate, like yourself, and also institutional type package products more along the line of what Grayscale says as well. So I still think that could be a potential input where like 1, 2, 3% of their portfolio could gradually flow in there, because they're like, this is a good way to quickly fill the unfunded liabilities that sort of just been cropping up, for decades at this particular point.
Yep, especially as more quote unquote larger names get into the space, right? Like Paul Tudor Jones and more institutions that people recognize. It takes a little bit away of the quote unquote career risk, from the space in terms of just allocating to it. Right? I think a lot of the times people don't necessarily not believe in crypto or Bitcoin or the expected returns. It's more of just, if you do allocate it, there's a bit of risk from a institutional name and personal career risk. And so getting over that hurdle as more larger names get into the space, well, then it takes a little bit of the edge off and people feel a little bit more comfortable actually kind of following along, right? And I think that would do a great deal of adoption as well.
That makes sense. I think that's one of the more interesting sort of questions, like outliers that sort of just hang on this market. Do you think for the foreseeable future that retail FOMO will continue to drive and like flow in, especially as, again, like some of the more not flavorful but more popular type assets like DeFi continue to drive additional interest in the market, but then obviously now Bitcoin is starting to get back in that mix as well?
Yep. Yeah. I mean, retail FOMO and just retail, fever is something that exists in all asset classes, exists in the beginning of time. I don't see why it wouldn't continue to exist in crypto, right? Anything that can go up 20, 50, 100% in a day, in a week, is going to attract retail investors, right? Especially now as more and more pipes and on and off, ramps are being built to crypto. Everything from Robinhood to PayPal to Revolut and all these different platforms that will enable retail, investors and to get in and out of crypto easier, it's just going to make it so much easier for them to kind of participate in these markets, right? And so, absolutely, I think in the near term, the long term, retail is going to be a huge driver of it, especially for some of the smaller coins and newer subsectors, right, like DeFi, because the larger institutions aren't going to participate in these anytime soon, right? They're going to participate in Bitcoin, maybe Ethereum, but in some of the smaller coins, I think it's absolutely going to be dominated still by retail.
Got you. Yeah, I think there's always going to be a subsegment of it that is always going to be dominated like retail, just given, again, like we talked about, some of the liquidity issues and constraints there as well. So do you have a primary, I know you guys are market neutral, but is there like a thesis that you guys have in the back of your mind for where you see 2020 moving to and pushing in to 2021 as well, that you're like, all right, we're trying to position ourselves in this particular way because we think it seems like this early stage narrative is playing out. So we want to make sure that we're positioned appropriately to be able to take advantage of that.
Yeah, I mean, I think similar to just what I mentioned before, and similar mindset we have since we launched the firm is basically that derivatives are going to be massive in orders of magnitude larger than spot markets or other assets within the space, right? We're starting to finally see a ton of options adoption. There's going to be new exchanges popping up this quarter, next quarter. We're seeing kind of the education permeate through the space in terms of just getting retail customers and institutions comfortable with what options in digital assets can actually be used for. And we're just seeing a lot more like corporates in the space, from lenders to miners, that are starting to use options a lot more as a way to kind of minimize the volatility of the balance sheets. And so for us, it's the opportunity set is less about, oh, do I think AVE or synthetics are going to go up 100% in price, more of just position ourselves in what areas are going to be the fastest growing segments, what are the instruments that we can use to participate in these segments, and afterwards kind of taking advantage of that. And so for us, just saying it again, it's basically just we really think derivatives and even crypto native derivatives, right? Like hash rate derivatives, something that doesn't exist in traditional assets. I think could be a big opportunity. Things that only exist because of the way that digital assets are. I think could be huge, right? We don't simply just have to copy and paste, create another VIX for crypto, which, while I think it will be immensely popular, I think there's so many things in digital assets that can only exist in the digital asset space. And I think we're going to, start to see derivatives products built, for that. And that's extremely exciting.
Do you think obviously the first layer is going to be more centralized, but do you think eventually the grand vision of decentralized finance, DeFi, will eventually take shape and derivatives will move there as well? So in theory, I love the idea of DeFi, but in practice, I still think it's a long way to actually go to be able to meet a real world need, but also do it in a reliable, scalable, and secure way. So, that's a little bit loaded given I've just sort of put my thoughts out on the paper there, but how do you feel about that in terms of derivatives for DeFi at its current stance? And do you think that it will eventually get to that particular space, or do you think there'll always be the bulk of the liquidity will be on centralized exchanges?
I mean, I think the way I draw parallels for that is basically similar to generally how institutions and retail view digital assets in general, right? And so it's going to take I mean, it's already taken a ton of time for the institutions to get comfortable with Bitcoin. It's going to take just as much time, if not more, for them to get comfortable with actually transacting on a decentralized exchange, right? And at the end of the day, it's kind of like, well, if they just want Bitcoin exposure or digital asset exposure, they can get it from centralized exchanges or even derivative centralized exchanges like futures as opposed to physical Bitcoin, right? So, I think it's going to be a long time, and maybe it never even happen that large traditional institutions ever get comfortable with DeFi, because there's no product market fit, yet, right? But I think that for retail, right, just look at what's been happening on Uniswap or 1inch and on these various DeFi platforms and decentralized exchanges. Volume has been spiking in the past couple of months, and so for the average retail user, they're getting up to speed very, very quickly. They're getting very, very comfortable trading and transacting on these exchanges. And I actually think, I think it's going to surprise actually how quickly, some of these platforms actually start to eat into the market share of centralized exchanges, right? And then for us that are, while we're quote unquote a fund and institutional, we're not, an institution in the traditional sense. And so we're going to go where the opportunity is. We're going to go where the volume is. As the infrastructure gets built up and we feel a lot more comfortable deploying more capital, we'll be very, very quick to deploy capital on these decentralized, and DeFi platforms, right? And so if that's where retail wants to go, then we'll follow because that's where the opportunity is. And I think there'll be a vicious cycle by then of just more users, more funds and trading shops like us, which will grow the liquidity and grow the infrastructure. So I actually, I'm quite positive on how the space will evolve.
Interesting. Do you think that, do you have like a specific time? Obviously, forecasts are notoriously shit, but do you think that, that could happen as quickly as 2021?
I think so. I mean, it depends on what you deem a, quote unquote successes, but, I think that, right now, even DeFi on certain days have taken 4 or 5% of the market share of centralized exchanges. Maybe you think that, 20% of market share is extremely successful. Absolutely, right? I think it could by 2021. I think the big question mark eventually is what regulators view DeFi transactions as. I think in the US, the SEC and CFTC has essentially not directly said, but at least indirectly held the belief that DeFi or decentralized transactions on decentralized exchanges are essentially off-exchange swaps, right? And that's a big gray area in terms of general financial transactions. All that needs to be reported. Obviously, none of that is being reported currently. So I think the regulators will get ahead of it quicker than they did with the ICO market. And so it'll be interesting to see what they ultimately decide on in terms of this DeFi market, how they view it, how they want to regulate it. But overall, absolutely, I think, we can see things pick up steam, extremely quickly, definitely by 2021.
Interesting. And then you think, so you guys don't participate on any decentralized exchanges and or aggregators like you're sort of talking about with 1inch and Paraswap and stuff like that?
We do. We trade on one. We use 1inch. We have our own private MetaMask wallets. We participate on Curve and Balancer and Compound, but very, very small, right? Just the amount of capital where we feel comfortable if there's ever actually like a smart contract risk or a hack or anything. More to learn about the opportunity so that if it grows and scales and becomes more secure, we know exactly what we're doing and we know exactly how to deploy the capital smartly and efficiently.
Interesting. I find that really, really interesting and also incredibly smart as well. So we, for the fund, we don't necessarily participate just yet, but like personally, I participated in there as an additional sort of like foray into that, where it's like, okay, if this gets to the point where it makes sense for us to do this for the fund, then our learning curve is far shorter. Do you look at DYDX, like the derivatives exchange built on Ethereum as well?
We've looked at a few of them like that, open. Those are a bit tough, I would say, because with derivatives, the edge cases, the permutations are infinitely more complex. We're a bit more hesitant on it because just coming from a derivatives background, we understand how difficult it is even to risk manage for an exchange to risk manage a product like that, even on a centralized exchange, right? A lot of times also like an open, you need a fully collateralized contract for better or worse. And so it's not very capital efficient for a market maker to use an exchange that's fully collateralized. So you have the cost of capital, you have the complexities and the risks and the smart contract risks So for derivatives on a decentralized exchange, I think will be perhaps a little bit slower in terms of deploying capital versus just the general spot markets.
Gotcha. That makes sense, and you guys have the experience to be able to sort of handicap that in a way. And obviously with open, with the recent hack, there's
Right.
an additional layer of technical risk that I personally don't understand because I don't have a technical background. But I've speaking to people that do have that background, there's still a lot of rough edges there in terms of technical risk. That you're sort of like alluding to, and was most recently exploited with open.
Yep. Absolutely.
So before we wrap up here, is there anything that you guys have going on in your world that you want to make sure that the listeners or the viewers know about before we wrap up?
Yeah, I mean, something that we've always ascribed to is just being very, very open, kind of crowdsourcing ideas and teams and individuals and speaking. That's how we met you, right? Chris, is something we do is basically, we're not kind of a closed off fund. What we do is, we have built the infrastructure, the back testing, research, data, execution, and basically we work with teams and individuals who have good ideas, who have existing strategies, or even ideas that they think can become a strategy. And we're more than willing to provide the infrastructure and data and even capital, for you to test your strategies and ideas out on, right? And so there's a team out there that's listening, or I think they have interesting idea, or just want to bounce off certain things with us. We're more than happy to take the call and see if there's a good fit.
Excellent. Yeah, I mean, I can attest. Having a relationship with you guys in some framework capacity for, I don't know, we're like pushing a year now. That's what's great about this space, is that it's quite collaborative. It's not necessarily so cutthroat like where in traditional markets, it's very much along that side. We're still in the space where we're all kind of just figuring it out given how early stage we are here. Yep. So the collaboration is really, really positive and really, really powerful. And Ledger Prime, I would say, was one of the first ones that I came across where they were open and out there to advertise. So I definitely concur with that as well. If there's any teams out there that are listening, Shiling's a great guy, and he's definitely more than willing to have a conversation. So with that, thank you so much for your time. I really appreciate you taking a little bit out of your day to come on and
of course,
talk about, all this general fun stuff, or hopefully stuff that we find fun or our viewers find fun as well. I can't wait to have you back on the podcast as well in the future.
Yeah, absolutely. Anytime. Again, very appreciated, and thanks for having me.
All right, everyone. Thank you so much for tuning in. I will see you next time on a new episode of the Crypto Muay Thai podcast.